Welcome, one and all. This is the Stocks and Markets podcast, and we've got an extra jam-packed episode to share with you this week. I'm Chris Versace, portfolio manager of the Street Pros portfolio, and joining me this week to break things down are Street contributors Louis Yanis and Noah Widener. But you'll want to stick around because toward the end of today's podcast, let's just say that we've got a surprise guest, a mystery guest, if you will, who will be joining us. But as we get ready to begin today's episode, just who are the players joining us today? Well, you guys know Louis. He's a returning guest, and I'm sure you've read his stuff over at The Street Pro. But this is Noah's first time on the podcast. And then for those, if you're unfamiliar with Noah and his work, just so you know, on the one hand, he's a financial markets reporter for The Street, covering stocks, investing, and U.S. markets. But on the other, he pens The Street's daily stock market blog every day. So trust me, if you're not reading it, it is something that you want to. Louis, welcome back. How are we doing?
I'm doing really good. I moved to Austin recently, and we're actually finally settled.
Oh, congratulations.
Yeah.
I'm just about to put my house on the market. Any words of wisdom?
The market. I don't know what the market's like in your neck of the woods, but in Colorado, where I have a house still for sale, it's very slow. And we can talk about
how long, if I may ask, how long has it been on the market?
We've been on the market over 70 days now.
Oh, wow, that's long.
And the average in the price range that we're in is 75 days. So we're hitting right up on the average. And I've been collecting a bunch of intel in the retail market, with a retail, or I should say, residential home market, because I talk to clients and learn a lot about what other people are experiencing in other parts of the country. So the housing market is definitely slow across the board.
Well, let's put a pin in that, because I do want to come back to that. Noah, Let's turn to you. You're kind of the resident newcomer around here. How's it been since you joined The Street?
Yeah, it's been fantastic. Yeah, it's every day, as they say. It's fantastic to do this work. Literally, just like I'm staring at stocks like right now. Like I got a monitor behind here. When I'm not looking at you guys, I'm looking up here to see if there's anything crazy is going on. Today, we're obviously filming on the 9th, so like any minute, Tim Cook is going to take the stage at the Apple keynote. So I'm making sure we're not missing anything there. It's
excellent.
Always on.
I will say this: my expectation for the event is extremely low.
I think that makes sense. Yeah,
and I say that is, if you were to look around here, you'd be like, oh my God, you have more Apple products than the average person, and it's true. It's absolutely true. I just think, the hardware is going to be very iterative this year. I'm more waiting to see if they surprise us with anything, maybe on the AI front. Maybe Timmy talks a little bit about the expected upgrade for Siri that's pushed out till next year. But by and large, I just don't see a lot of, excitement, to be candid. Do you guys agree, disagree?
Yeah, it seems investors are feeling that way this morning. Stock is down. So as it tends to be on September keynote day, there's been a little movement going into the conference, but it's been down close to 1% all day.
Yeah. Louis, are you playing this at all, or just whatever?
No, I'm not really playing that. I've been focusing in on a lot of tactical moves on exiting certain investments and strategy, more macro type strategies lately, and we can get into that later. But I'm not in any way playing that.
All right. Well, let me set the stage for where I want to begin today. So we've got a stock market that, it's not so far off record highs. The economy appears to be slowing. I believe Jamie Dimon just came out and said something to that effect. The consumer increasingly bifurcated. We've had big job revisions to the downside, inflation by all account not cooperating, and growing expectations for the Fed to do something, if not more than something, next week. And all this is unfolding during what's typically a month, September, that is one of the seasonally weakest months of the year. But yet, so far, the S&P 500, it's still up modestly month to date. So, guys, how are we feeling about the market overall?
Well, do you want me to start?
Sure.
So my feeling on the market right now is that we still have that same issue where we have a lot of concentrated, overextended stocks that are affecting the S&P 500. I was on a call this morning talking with a very large client of mine, and we were just going over the numbers. And when you got the S&P 500 over the last 3 years up something like 75% total return, and then the Russell 2000 up like half that, it's just indicative of what's going on. And I told this client that, I've seen this happen a few times in my career, and every time I've seen this happen, it's not been pretty. So that's my view on that. I think
Well, hang on. So I rattled off all those things. And any view on what's the straw, Lewis, that might break the camel's back? Is it possibly that the market expects more than the Fed will deliver?
I think that the market's already kind of discounted all that. If you look at the bond market's been discounting that. I think valuations are, look, if you look at an RRG chart, I don't know if you're familiar with those, but it's a relative chart showing rotation of various markets. If you look at the NASDAQ and you compare it to other markets, and if you just go from that low, which was like 22 weeks ago, we had this massive improvement in return, and it's just been rolling over the last 9 weeks, and that's a technical indication of really, I think, indicative of the valuation issues. I think the market's very vulnerable to a drop in capital expenditures over the next 12 months, and we have to be very careful with this market. So my thing is allocate capital rational, be selective, see the long term, and focus on those key factors that make good decisions, that helps you make a good decision with regard to each holding that you have. And that means understand the key drivers of what's driving returns in that particular investment. Be diversified, and don't be afraid to have a little bit of dry powder.
So, Lewis, let me stick with you for a second. You mentioned, CapEx potentially falling, yet when we're in big tech land, AI and data center, we just seem to see these numbers go higher and higher, whether it's, Meta talking about 600 billion in spending over the next few years, OpenAI over the weekend talking about, its spending being massively higher than previously expected. So if we kind of net it all together, is that worrisome from areas outside of, AI and data center spending?
I think so. I think, listen, if you look at how consumer behavior responds, it's not just a gradual thing. Usually there's like you said, a light switch. And I'm not saying that I see an impending doom or of any sort. All I'm saying is that if you just are allocating capital based on fundamentals, we do have increasing fundamentals, but I feel like the valuations themselves are ahead of those fundamentals.
Yeah. I can see. I mean, look, you got the S&P 500 north of 24 times earnings that have been coming down for the back half of the year. I've written about this quite a bit, to pro portfolio members, and yet we're still kind of trudging higher, getting ready for the seasonally, or one of the seasonally strongest times of the year. Noah, I'm sure you're seeing this. How are you thinking things are kind of setting up for the back half of September ahead of this all-important year-end push?
Yeah, I mean, it seems like one of the consensuses, like among analysts, is that there was going to be some sort of volatility either in the latter half of 2025 or in early 2026. And I think a lot of like year-end price targets for like the S&P seem to reflect that. Various banks are like pretty measured in whether or not they think that we're going to be higher by the end of the year or we're going to be higher by the end of like 12 months from now. So a lot of those targets came out June, July, August. I think a lot of what's happening right now hinges on people want to see this inflation report. I think it's all really been a lot of fiscal dominance that's been driving the market. And I think that there's definitely a story to be had about how earnings quality has been improving. But to some extent, I assume that the quality of those earnings is going to be affected by inflation. To the extent that these targets continue to decline, the earnings targets for future quarters continue to decline, and the volume of inflation seems to be ticking up in a number of different indicators, it would kind of stand to reason like, well, are you getting any real earnings growth at all? It seems like that's going to be the case, but we can't discount where a few months ago they said, oh, there'd be no inflation from the tariffs. And now we're living in a different world. And, later this week, we might get a little more clarity. I think ultimately whether or not the markets are going to do anything in the month of September probably comes down to those two critical reports, the PPI.
So you're referencing the CPI and the PPI reports.
Yes.
Yeah, I agree with you. And I think if we take a look at some of the other August data that we've gotten, particularly the ISM pricing data, manufacturing and services, whether you look at it, as reported, or you take a 3-month trailing look at the data to kind of smooth it out a little bit, there's no question, right, that in August, these pricing pressures continue to be at extremely elevated levels. It leads me to think that maybe the Fed delivers something next week, but when we look at the market expectation for 3, now almost 4 25 basis point rate cuts, Lewis, I think the market might be a little out over its skis on this.
Yeah, I think so too. I think the market is really kind of going to the likely end result already. And there's a lot of people that irrationally are thinking that somehow magically, once that announcement hits, that there's going to be a magical economic ignition that turns on. And I don't think that's the case. I think that when you wait, by the time you wait for something, it's a news item. It's like buying the rumor, selling the news. Like we know how this market works. So in my opinion, that rally that we saw over the last 23 weeks, that was the rally that was anticipating all this, and that happened already. We're going to hit the news item, and as a technician as well as a fundamental guy, my guess is that we'll head into some chop, and I don't think we're going to have a crash necessarily, but I think we're going to head into some chop as the market digests this. It'll be like, okay, we got the news, and maybe we'll get whether we might get an initial jolt if the Fed does something more than everybody anticipates. But how can they? We're already anticipating so much, right? So
Yeah.
To me, it's likely to be a letdown. And the best thing to do right now is to focus in on to react less and reason more. React less and reason more.
So let me stick with you on that, Lewis. If the thinking is that the Fed gives us something next week, maybe it's 25, maybe it's 50. Is there the risk, and I want you both to weigh in on this, is there a risk that all of a sudden the euphoria fades and then folks go, oh, why do they need to deliver or go bigger than we expected out of the gate with September? Why do they need to deliver that 50? Does that kind of, as you just said, stick with the reasons, does that lead to a revaluation of expectations in certain parts of the economy that might be weaker than expected previously?
I do think a certain segment of the marketplace will say, "Hey, the economy is slower than we thought." If they do more than 25 bips, I think there'll be a segment of the market. I don't think it'll be the majority. There are certain types of companies that would benefit more directly from a 50 bip rate cut versus a 25 bip, and I think that's a real thing that you can consider in valuing a company. But in terms of the general marketplace, there's going to be a lot of cross currents. So that's why I think, the technicals are setting up for pause, volatility, trade range, not crash. That's my opinion right now.
Noah, what do you think?
Yeah, I think there was a note out from JP Morgan yesterday, kind of along these lines, that they said that most of it has been priced in at this point. The market, of course, anticipating this 25 basis point cut. And there was separate commentary, and I'm blanking on which bank it was, but a common thing you see is that bad news is good news. Mm-hmm. I don't know how, given the tepid pace of the economy and all of the markers that we have coming out, I think investors have a tendency to be quite cavalier. I don't know if that's because the algos don't understand or if they choose not to understand, but it sure seems to be that the market has a bias to the upside, even in times of great uncertainty. And when you're looking at, the 30+% rally in the S&P 500 since April, and you're looking at that in terms of, well, is that anticipating a 25 basis cut? Or is this anticipating a whole regime of cuts, the restarting of that regime of cuts? Now, there's research that goes back over, like 30, 40, 50 years. Goldman Sachs says every time they restart a regime of rate cuts, it usually results in an increase in stock valuations. But if the anticipation is so great, it does it stand a reason that the 12 months kind of teed off the moment that we started, in anticipation of this cut, so to say, when the rumors started making the rounds that the Fed would begin considering a cut once inflation fell below, the target rate, or in this case, it didn't fall below the target rate. It got very close. I think that that's a big question. I think everybody is along those lines probably going to wake up from, this bad dream where bad news is good news and kind of look around. It's going to cause a reprocessing of all of the information that they've received in recent weeks. And I don't know if it's going to stir the necessary, steps to get us the 50 basis point cut. I'm not even completely confident that in light of, and it's too early to say because we could all get clowned on and see this inflation print. It might be quite standard.
Sorry. Let me back you up there for us older folks, Noah.
Yeah.
Clowned on?
Yeah,
you
clowned
want to
on.
That?
That's a good one.
Yeah, clowned on like we get pranked, like we get trolled, we get surprised. I guess is just as clear a sentence. It could be quite a nominal inflation print, at least relative to what we've seen over the last 12 months. And in that case, then maybe you have the justification to go ahead and prioritize that dual mandate, that labor part of the dual mandate. I think that is obviously what everything hinges on. So I don't want to jump and say we're not getting a 50 basis point cut or we're not going to get a 25 and a 25. But I think in light of the current pace of inflation and how it had been ticking up, it's very difficult for the Fed, and it's much harder now that the Fed has been wildly politicized. So I don't know where the market falls on that, but they seem to be just trucking along without a care in the world, to be honest.
Yeah, I think that, and you guys can certainly weigh in on this, let's just game out what we're getting between, now and let's say the afternoon of, I believe it's the 17th, right? So we'll get the CPI report, the PPI report. The expectation is that the core numbers are going to, remain at lofty levels. And then it's kind of smooth sailing. We might get a couple other economic data points. Then next Wednesday, we get the policy statement. We get the updated set of economic projections, which I think will be key. And then, of course, Powell will speak. And I'm kind of waiting, I think, like Noah, we got the August employment report. We got the revisions for the 12 months, through March 2025 that saw a loss of 911,000 jobs that we thought we had. But yet, if the CPI and PPI are hotter, the question is which one is a greater factor in the thinking of the Fed? And just given all the work the Fed has done to kind of, fight the inflation fight, Lewis, I think that there's more of a risk that they do less.
Yeah, my guess would be they do less because it's a safe thing to do. If you look at Powell's track record, that would fall in line with history. At least his history. Here, you said something about waiting. I think that's the issue. Everybody's waiting. Pick the market, real estate market, stock market, bond market. Everybody's waiting, and if everybody's waiting, we're expecting something. So you could either buy, sell, or you can do nothing, right? And there's a lot of capital that can be sloshed around. So, in my opinion, the waiting itself is telling you that there is basically going to be a ho-hum scenario. No, like if we get 50 bips, there's going to be some market participants that are going to say, hey, the economy's too slow, and others will buy and sell. I think what you're going to see is more volatility. You always typically get a initial reaction on the news. It's a knee-jerk thing, right? And then you have a settling out. So I just think that's where we're headed, into that kind of a scenario. But listen, there's two elements to a valuation model for stocks. We all know this. There's a discount rate, and then there's a growth rate in earnings, right? What we're looking at is both of those. If you look at that equation right now, maybe we'll get it. We've already gotten a discount rate drop, right, as the market's anticipated the lower rates, right? When you've got the long end of the yield curve and you got the short end. We're talking about the short end here, right? But the market is discounting at the long end of the yield curve, if that makes sense. So I'm really more focused on the long end of the yield curve, the inflation expectations, and the growth rate itself. Sometimes you have this sync where discount rates come down and growth rates go up, and that's when the markets really kill it, right? I don't think we're in that kind of a scenario. I think we're more in a lockstep where they're more in a Keynesian type move for those people that have studied economics. This feels very Keynesian-esque. And the long-term problem that we have with the budget deficit is the root of the problem that we have here.
So you just mentioned earnings as one of the two levers. And, like I said earlier, we talked about how consensus expectations for the second half of the year have been slowing. do we need to see companies kind of surprise to the upside and deliver, rosy initial 2026 EPS forecasts? And I say that because typically around this year, like auto magically, and I can't explain to either one of you the how or the why behind this, but it's almost as if the market anticipates, earnings next year, of course they're going to grow in excess of 10%. And then throughout the year, they kind of get whittled down. So does it need to be, even bigger than 10% for the S&P 500 for next year? Meaning we need to see a lot of numbers, particularly for the Mag 7, move demonstrably higher.
I would say yes. I mean, we're priced for that, right? I mean, we better have something that's above expectations, or we're going to have an issue. I mean, that's where we're at. If you take the largest cap stocks, it's baked in the cake, baby. We got to see something big, or it's not going to be good. It's going to be volatility.
This is one of the more colorful podcasts, I have to say. Getting clowned, baked in the cake. Noah, in your assessment of things in the market, are you kind of seeing what we're talking about? That like the market, the expectation for earnings really has to accelerate. Otherwise, perhaps the market now, not individual sectors or stocks, the market kind of stalls out. And I think you alluded earlier to some benign S&P 500 price targets. You didn't say it, but around like 6,600 or so, saying 2% upside from here.
Yeah, it seems a lot of banks either are seeing very basic numbers in terms of upside, like very low single digits, or actually some downside. And in some cases, some banks have actually issued worst case scenarios. Like I think UBS has issued a worst case scenario where a number of different, factors kind of turn into the confluence of like tariffs are affecting everything. Earnings growth actually declines as a result of just the confluence of factors. As it stands, I pulled up FactSet when we were sitting here, and the most recent FactSet guidance report said that more companies issued positive guidance for the coming quarter. But even though they did that, the S&P 500 is expected to report year-over-year earnings growth of 7.5% in quarter 3 2025, and that is, I think, the lowest rate that we have seen since the first quarter of 2024 when it was negative.
So you're looking at the earnings insight report, right? Which is mandatory Friday reading in this.
Absolutely.
Hour. So if you skim through the pages, they've got one page that's got annual EPS numbers and then quarterly EPS numbers, and I track those every week. And if you were to go back to the end of March, right, second half EPS growth 13.9%, higher than the first half. Yeah, now it's like 5.6%. So earnings have just come down.
Yeah. The expectations, I think, for what it's worth, were always relatively lofty going into this year. Like if you go all the way back to when started January, just the sheer amount of expectations. I don't know if it's a mix of the expectations of the Federal Reserve and also the hopes about deregulation by this administration.
I think let me cut you off right there, and Lewis, pile on if you have to. I think it was the Trump enthusiasm, tax cuts, right? Deregulation. We're going to turbocharge the economy. And I got to say, I don't think we really got a lot of that yet. In fact, we got saddled with tariffs and higher prices. Lewis?
These things take time to happen. So you have the initial, announcement of what is supposedly going to happen. And then you have what really happens, and you have that lag, right? So I think for anybody to expect all that to hit the actual numbers right now that's a little premature. It takes a little bit of time for that to happen. And the market made an initial assessment, and then the ball got, in my opinion, the whole target got moved. As soon as that tax bill came out, to me, that showed a different signal than what was actually discussed. We're back to just spending like crazy, like drunken sailors, and we're going back to the same old, same old. So, and I think the market is going, okay, now we better adjust our expectation about that. In terms of the tariff thing, in my mind, that's basically, it's like a consumption tax. And, we need some kind of a tax. Somehow we need to generate revenue. So we're going to do it. There's different ways to do it. We could tax the capital, and that's affecting the economy. And because it's really, really important, because the capital gains tax rate and that income tax rate really affects the consumption and investment. And so in my mind, that money comes in one door and it goes out in another, right? Because that tariff money comes into the coffers and then that gets spent, right? So and that'll show on another side of the ledger if you understand the economic accounting of this thing. So I'm not so worried about that as much as I would say the headlines are. I'm more concerned about the actual will the investment actually happen, right?
Mhm.
And even if the investment does happen, there's going to be a lag, as you know. When you invest, it takes time for you to get a return on investment.
And
So
when you say these investments, are you talking about these reshoring activities that the president is kind of pushing for? Because
yeah,
I hear some of them, and the one side of me is like, oh, this sounds pretty good, and on the other side, the cynical side, I say, geez, it takes how long to build a steel plant? It takes how long to build an auto plant, a semiconductor manufacturing plant, blah, 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 right? Not only does it take time to feel the effect, but the landscape could change between now and then. Noah, what do you think?
Yeah, I mean, regardless of how much we've already done, and I think it's preemptive to say for sure, but so far when polled, and I don't know to what extent, to what effect a thermostatic popular poll is a great way to assess the new Republican tax and budget bill. It's a wildly unpopular bill. I think a lot of people heard that it gives tax cuts predominantly to wealthy people, and that's just by virtue they make more money, and as a result of having a lower top marginal tax rate continued from their 2017 bill, of course they're going to save more money. They were already saving money relative to other people where the average savings are a few $100. I mean, something to the effect that I think half of the United States has a negative effective tax rate. So like this is kind of the sparring is we're going to spend more money and we are going to collect less revenue and we are going to diversify where we are receiving that money. And I think that the message to the majority of Americans is we're actually going to be taking that money from you because like it or not, these tariffs will be passed along, whether that's from the suppliers to the wholesalers to the American people. I think the takeaway is this bill is already right out of the gate hilariously unpopular. And I don't know if that results in anything meaningful down the line. I don't want to be passing too much judgment, but it seems at this state, manufacturing jobs continue to decline. I think we're down something that affects 78,000 manufacturing jobs this year. There's not a whole lot that's happening right now that would induce confidence in certain fields where you say, like, we have a problem in general. That America doesn't really fundamentally build anything. And I would argue that it's probably more likely that it's because lawyers get in the way and permitting processes, and then the environment changes. And by the time,
hang on, I have to make this snarky comment.
yeah,
Lewis, I thought I was being cynical earlier. Jeez, lawyers, blame lawyers, an easy target.
I mean, absolutely. Well, and you look at public, and I'll just take a segue for a second. You look at public infrastructure. I live in Seattle, so the people of Seattle passed Sound Transit 3, which was a piece of legislation, or not a piece of legislation, but like an actual ballot amendment, a proposal to extend public transit in Seattle. And it costs billions and billions of dollars, levies a new sales tax, all these different things. By the time that they have actually passed it, I think in 2019 to today, the project has doubled in price because of inflation, because of the cost of permitting. And people say, oh, well, that's the government's fault. The government's so inefficient. Well, we could say that the government is wildly inefficient, and maybe to some extent that could be true. But then there's this other, acting force, which is just inflation continues to rise. It continues to eat and create a more expensive budget for these sorts of projects. And that's just very downstream of the bigger problem, which is that we just don't collect enough revenue in the federal government to justify the spending. I think a lot of people are generally very supportive of the spending and where it goes. People love this infrastructure that we're doing. I mean, it didn't really help Democrats win any elections because nobody cares about infrastructure, but people love the infrastructure when they get to use it, right? And so we spend that money.
First off, people care about infrastructure when it doesn't work for them.
True.
People understand that, whether it's bumpy roads, horrible tarmacs at airports, and the like, or depending on where you live, subway or metros. Lewis, I saw you chomping at the bit, trying to say something. Go right ahead.
I'm holding back.
Are
Well,
you are you puzzling through, Lewis, whether he's more angry about lawyers or the government?
well, we're all going to always agree on the lawyer part because there's no lawyers here, so that's going to be easy. So no, I actually think you've heard that thought process where you always want to go to first principles, right? You just keep going back and get to the root of something, and I think the root of all of this discussion is the desire for a free lunch. The one comment I don't remember who, I guess
Lewis, there is no free lunch.
exactly, but there's a desire for it, right? So,
Yeah.
there was a comment that ultimately the consumer is going to pay for it. Well, you know what? It doesn't matter what strategy you take. Ultimately, the consumer is going to pay. Just pick your strategy. You want to take a supply side. You want to take a demand side. Let's say you do a supply side with monetary policy. Ultimately, everybody's going to pay with lower your dollar not going as far, and inflation will take it away from you. Confiscation, silent, right? Okay, let's say we take a demand side and we do all this spending stuff we keep doing. We just basically we're just not wanting to pay what we need to pay. And ultimately, austerity is the ultimate end that is required to solve a problem that we have. And we have a lot of political debates that go around, and round, and a lot of it is minutia. We're not talking about the real root of the issue. You can't keep doing what we're doing. Now, and we're going to have to deal. We're going to pay the piper one way or the other.
Well, I'm getting really depressed here talking to you two. I was expecting a fun, entertaining conversation, and I feel like I got to go nurse a beer somewhere. But let me see if I can pivot before we get out of here. And I talked to our mystery guest today, Lewis. What are some of the things that your money management clients are coming to you with? And second part, where are you seeing some opportunity, or on the periphery, where are you potentially seeing some opportunity as we look ahead the next 3-6 months?
The number one thing I'm doing right now is managing people's concentrated positions that we've made so much money in over the years, and reducing those positions with strategies that will tax loss harvest, getting that money diversified into broader areas, other areas that have better expected return on investment. We have made way too much money in certain stocks, and it's time to reduce them. We've just been doing it for a while, but now it's like even more so. And I'll tell you what's making it accelerate is when I have people who work for large, very successful tech companies, and they're the ones that usually you try to get people to start diversifying out of concentrated, highly appreciated. You try to help. You have to really convince them. Now they're trying to convince me to do it now. That's telling me
interesting.
That is important. And then the other thing, in terms of opportunity, what I see the opportunity is having some dry powder. And I still believe that the private markets are going to offer opportunities in the go forward, because companies will continue to stay private longer, and a lot of the next gen growth opportunities will be in the private markets. And in terms of in the United States public markets, I'm basically looking for value and stability and quality. So without mentioning specific names, I'm buying quality.
I was going to say that's pretty vague.
Yeah, it's you know what? It's hard to find, and the problem is the valuation part of it. You can find quality, but you can't find valuation. So it's all relative right now. If we can make better than the risk-free rate of return, my expectation on the general stock market over the next couple of years is like 7-8%.
Okay. And just because I know people are going to ask probably in the comments below, when you're saying valuation, PE, PEG ratio, enterprise value to revenue, enterprise value to EBITDA, all of it, any one stand out?
So it depends on the type of business it is, but it basically is the free cash flow to equity that matters for any company.
All right.
What's the free cash flow to equity?
No, a quick question for you. What things are you kind of seeing bubble up on your radar screen, and what are you writing about that really seems to be getting a lot of attention or reader interest?
Yeah, it seems that everybody wants to hear about the indexes and what banks and what Wall Street is saying about the indexes, which is understandable because they seem very authoritative on this issue. And I think they are, in many cases, the analysts are just, putting out the price target relative to what they see in front of them. And what we see is not necessarily super supportive of where we're at right now in some cases, at least right now. Not saying that over the next 12 months, there isn't room for equities to continue going up. But people are obviously very interested in what Goldman Sachs and JP Morgan and Bank of America and UBS and all of these other smaller managers have to say on that. In terms of things that are interesting, something that hasn't gone away all year is the discussion about healthcare stocks specifically. It seems that there kind of has been a bit of a detour on healthcare stocks, in large part because, when the Trump administration came in, they promised things like cheaper drugs, and so then drug tariffs, and then also some semblance of a plan on what to do with healthcare. And a lot of healthcare companies, particularly that are touching government plans in the marketplace and touching Medicare Advantage, have been hammered this year.
Yes.
Like United Healthcare is one of the worst performing stocks in the S&P 500. And that's really saying something, because to be one of the worst performing stocks in the S&P 500, you got to be having a really, really bad year. You got to be doing worse than like 499 other guys. So they've sort of bounced recently. There are people that are preemptively buying back these health insurers. At the same time, there's been all these pharmaceutical companies and biotech companies that quietly have been kind of trickling up. I think that on the biotech side specifically, this rate cut story is a big deal. I mean, in a lot of these larger biotech metros like Boston and Seattle and La Jolla, San Diego area, there had been a lot of layoffs in recent years as a lot of the pre-clin early stage biotech companies were up absorbed, downsized. I think that the roosters come to roost. And in some of these industries, you would actually hope that soon you start to see not a contraction as you'd seen since the end of the pandemic, but particularly like an expansion where we're actually going to start seeing things happening in the healthcare, pharma, and biotech industry. I think that stands at least in stark contrast to the broader economy, but it makes sense when you look at like sectors and how they roll over different times of the market. I would say above all else, if you go look at a heat map of the S&P 500, the NASDAQ, what have you, on days where tech is down, healthcare and health technology is up. And there's an overwhelming consensus, I think, from taking that these two things are kind of counteracting. I think a lot of investors are quietly getting interested in healthcare finally. After, the months and months of hearing the earnings growth is going to be 15, 20% year over year, it might finally be coming to roost.
Well, I will say this on the healthcare front. We've got a massive demographic tailwind. I think we're both getting there, Lewis, as silver foxes, if I can put us in that category. But the aging of the population, Noah, I think you've got plenty of time before you need to worry about that. But I think that's a big tailwind. And I know it's one that we're taking a look at once again in the portfolio, especially if we get those expected rate cuts or more rate cuts than expected. Gentlemen, I want to thank you so much. Folks, please be sure to read what Lewis is writing about, what Noah has to say, and in the Street Live blog. It's a lot of great information. Gentlemen, thank you for joining me today.
Thank you for having me.
Thank you.
I'm not as bearish as I sounded today.
Well, we'll talk about that next time.
Okay.
And now, folks, let's turn to that surprise guest, that mystery guest that I teased earlier in the program. Please welcome the one, the only Jason Meshnick, managing editor of The Street and The Street Pro, but also editor at large at Autoblog. And Jason, thanks for joining me. And I got to say, I thought I was a busy person, but I don't know how you managed to do all that.
It's all about just prioritizing and then probably unfortunately not doing a good job on certain things that you should do.
I doubt that.
I do my
very
best.
much.
I do my best. We try to have fun.
Yeah.
Yeah.
So let me set the framework here for you, Jason. So most folks may not know this. I do. You're a CMT, but you've also got a little claim to fame in that you helped, create the Fear and Greed Index that a lot of us talk about. And I know there's some things that you probably want to discuss about that, but I don't want to talk about that today. I really want to talk a little bit more about how you like to tell stories with data and really zero in on a recent experience that you had as it relates to the automotive market.
Yeah, sounds great. And we can definitely cover the fear and greed index another time, not today. Because I think, um, it is one of the favorite things that I've done throughout my entire career. And I do love, as you said, Chris, taking data and telling stories with data, because I think, when we talk about the stock market, and we talk about what companies are doing, they're just such abstract concepts, right? Things that people, even if you went to business school and have an MBA in finance, it's still, when you talk about earnings, so many people don't understand it. They don't really know what it means, what goes into it. And so, telling stories and providing pictures and making it, really simplifying things so that people can think about it in a way that's more meaningful to them, is just so valuable. That's one of the things I love about the Fear and Greed Index. Um, but let's talk about that in the future another time.
Mhm.
I want to say, though, first of all, I love listening to Lewis and Noah. Um, and and while Lewis may have been a little bit of a downer at one point, I don't feel like we were clowned on at all. um,
No.
but I think when he talks about the roosters coming to roost, I think there's a lot. I think Noah said that. There's a lot that we need to think about. And so, what I wanted to talk about today, though, actually, first of all,
Mhm.
I want to say a big thank you to all of our subscribers, people that are listening today. Thank you for being a member of the Street Pro. We really value your membership and your participation in things like Doug's Diary and the Portfolio Forum, etc. If you are listening and you're not currently a member, please join us. You can always just go to the pro.thestreet.com. You can read the first article for free. And then second article, we ask for your email address. And by the third one, that's when we want you to start joining us, and you can take out a 1 month trial. Um, the other big thing, and I have a sticker around here somewhere. Well, we just started a newsletter called Filthy Rich Animal, and that is completely free. It comes out once a week. I write half of it, and another person, Kate Stalter, who's been with the Street Pro for a bunch of years, actually returned this year to help me write Filthy Rich Animal, and that is completely free. And it is something geared towards newer investors, people who are starting out, and helping people, even if maybe you're not starting out, but you're trying to manage your 401k, and maybe you're thinking about retiring. We try to provide content that is easy to read, fun to read, and we just try to have a good time with it, and hope that we engage with people, starting with the name Filthy Rich Animal, right? So we're just trying to have fun. Um, but Chris, let's get now to talk about the subject matter at hand.
Okay.
All right. So what I
Hit
wanted
me.
to talk about, yeah. So I did just have a big adventure, and it was mostly the adventure was presented to me through my work with Autoblog, with our sister publication Autoblog. But really, a lot of the stuff I want to talk about today is related to investing and related to money, and really, it's related to the Roaring Twenties. And I'm not talking about the Roaring Twenties from the 1900s. I'm talking about the Roaring Twenties that we're in the middle of right now. And I think that there are even some similarities to then
Roaring.
to now
Wait, wait,
versus
wait, wait.
the
Roaring
roaring
autos. Is that where we're going with this? Roaring
roaring
autos.
20s.
Okay,
And
let's hear
yes,
it.
some of the autos are going to be roaring, but the one that I really want to focus on, which I'll get to in a minute, does not roar. It used to roar, now it doesn't. So let's start with Car Week. So I was in Monterey. I was invited to Monterey um, through Jaguar Land Rover, because, and we'll talk about Jaguar in just a minute, but as many of you know, they're doing a big rebrand. So, but I had more experiences than just the time I spent with Jaguar. Okay. And one of the big takeaways of the entire time is that, just like in the original 1920s, Roaring Twenties, it's a really good time to be a billionaire. Um, so, yeah, if you have
Very
money to
insightful,
spend,
Jason. Very.
yeah,
No one saw that coming.
no one saw that coming. If you have money to spend, there are people out there who want to help you spend it, and they will help you spend it in really creative ways. I was at this one party called the Quail, and the Quail is, I can't remember how much a ticket is. Luckily didn't have to pay for it because I'm part of the media. It's something like $1,600 per ticket. And the people who are there, there are really two kinds of people. So you have all the auto manufacturers, and I'm not really talking about General Motors, even though they were
Right.
there with a new
Are we
Cadillac.
talking McLaren, some of the nice high-end automotive companies?
We're talking about McLaren as, and let's call McLaren a high-end manufacturer, but let's say that McLaren is pretty run-of-the-mill compared to some of the other people who were there. So, for example, I went over to the Roof display. Roof is RUF. They're a company that's been around. They started as Porsche tuners. Now they've actually been approved by the German government to actually be their own their own manufacturer. So they partner with Porsche, and they're very involved in the Porsche ecosystem. But they create these cars that are basically carbon fiber. I'm not going to say copies because that would be pretty unfair to them. Uh, carbon co- um, Carbon fiber versions of what Porsche, what an air-cooled Porsche might look like today, if Porsche had continued to make them. So imagine those, Porsches with the round headlights, the kind of the bazooka tubes in the front of the nose, these cars will sell for over $1 million and have multi-year waiting lists. The one that they showcased at the Quail this year was one called the Roof Rodeo, which is something that speaks to everything that I love about cars. It's fast and it's designed to go off road, sideways, and just have a good time with it. And I think it's something that doesn't take itself too seriously. At the even higher level, there's Gordon Murray Automotive. Now, Gordon Murray was an F1 designer and race car designer and built one of the most expensive cars of all time, which is a McLaren. If you wanted to buy a McLaren F1 from the mid 90s, that's going to run you well over $20 million now. And he has a new run of cars that run somewhere over $1 million if you can get your hands on one. But he partnered with another wealthy person. I don't know who it is, but they did a run of 5 cars under the GMA Special Vehicles brand. Um, this person went and bought all 5. I think the number I heard was something around $20 million. So you're talking $4 million each car, and you can go above there. So, like I said, really good time to be a billionaire. Um, but let's talk about the auction results for collector cars, because that's one of the other really big things at Monterey. So Monterey, it incorporate it. There's a bunch of different events that happen. So you've got the races that happen at Laguna Seca. Those are always a passion of mine. I love racing. But you've got the events like the Quail and some of the others, but then you've got Pebble Beach, which is the big car show. And going back 50 to 75 years, um, this week was really all about the racing. And then on the last Sunday of the entire time, it was about Pebble Beach. And I won't really go too much into Pebble Beach. I want to talk more about the auctions because I think that's more relevant for our listeners. And a couple things that I noticed around there. I only attended one auction. I saw one car sell for $5 million. It was the McLaren MC12, which is a car that is based on the Ferrari Enzo. It's what about 20 years old. I'm not super familiar with these, but it was amazing to watch this car go for $5 million. Some statistics. I'm looking over at my notes, and you can interrupt me at any time, Chris, if
Yeah, I
you
was going to
have a
ask
question.
you,
Yeah,
just what was the environment like at this auction? Was it, frenzied, or,
it's
a
party
lot of
time.
upbidding, or was it just kind of very sedate, put my paddle up and vote?
No, it is 100% party time. This is the great thing. So I attended this one. It was a Broad Arrow auction. So there's several different auction companies that show up, and each one has sort of a different vibe, a different thing that they're known for. Um, I'm not sure exactly what Broad Arrow is specifically known for, but they're part of the Haggerty group of companies. Haggerty is a public company. HGTY is the symbol. They put on this Motorlux event that is really the kickoff for Auto Week. It happens on the Wednesday night, so it's not a full week, but it happens on the Wednesday night. You pay around $600 a ticket to that. The manufacturers show up. Porsche had a display, Ford had a big display, several other brands were there, and there's different areas. You show up, and basically for your $625, you are very well fed. You have access to really great drinks, and it is one of the most fun parties that you can go to in all of car world. Jaguar was there, so I was invited through Jaguar, and I got to see their new Type 00, which I will talk about in just a second. I really want to get to that. Um, but you asked about the auctions. So Motorlux happens at the Monterey Airport, Monterey Jet Center, and the auctions take place in one of the hangars. You can actually interact with the cars before they go up on the auction stage. I will not confirm that I may or may not have sat in a couple of the cars that were waiting to go on auction, but they were available and people actually could. You could get
We'll
up there and
check your
touch them.
Instagram, Jason, on this.
I wouldn't post those on Instagram if I did sit in them, but I may have some friends who did sit in them. Um, the auctions themselves, it was a frenzy because people are partying and people are being plied with drinks. I actually wrote an article about this for Filthy Rich Animal, and people were having a great time, party atmosphere, and you wanted to cheer for the cars as they were going up on stage, and you wanted to cheer for the bidders and you wanted to cheer for those prices going as high as they could. It was a bit of a frenzy. Some of the things that were interesting, though, when we talk about sort of the blue chip cars that people are always looking at, it's always Ferraris, right? And traditionally, it's always been those Ferraris from the mid 50s. Those were the first, really kind of the first supercars, things that people were familiar with. They would be in more than just newspapers. They'd be on TV. You'd see racers driving them. Um, so historically, those have always been the big blue chip investments. In the last few years, those mid 50s Ferraris have actually taken a little bit of a dive. This year, they were back, um, but maybe not as strong as they had been. What was really strong were the more modern supercars. So, like that McLaren, or sorry, the Maserati MC12. Of the top 10 cars that were sold at auction, I think the number is seven of them were Ferraris, um, and sorry, eight of them were Ferraris. They were also, what was interesting, across seven different decades. So it was a little bit timeless, but the cars that tended to either meet or beat their the low end of of the expected sale prices tended to be the more modern cars. The older cars, even if they did sell, they tended to be a little bit on the lower end of the expected range. So I thought that was really interesting.
So Jason, put a bow on this for me of sorts, right? So
Mhm.
you're at this event, right? As folks who are investors, stocks, it sounds like you're kind of describing something more in the collectible space, not necessarily
Yeah.
stocks. So what's the message here that if you've got enough disposable income, contemplate buying a luxury high-end car and keeping it, or am I wrong on this?
Well, so I think in the collectible car market, and you're right, this was completely about collectible cars. Okay. There are a couple of different things to think about. So these museum quality cars that could fetch $1 million or more, those are going to be the ones that really are blue chip, and they will continue to be fairly good investments. The ones that you or I might buy, a lot of those are probably topped out. Um, I have an older Porsche. I bought it at a very good time. I can't imagine how it could possibly go up more in value. So I would say that for people like you and me, you're probably not going to make a lot of money on the collector car market right now. But if you are able to afford some sort of a museum quality car, those will always be in demand. The other thing that I think will always be in demand are race cars. I sent you a picture. I was racing
Mhm.
last weekend at Lime Rock, at the Lime Rock Historics, and I was racing against several cars, many of which were completely affordable by regular people. Some of these cars, the car I was racing was worth about $12,000, right? Something that,
Oh,
but the nice thing about it was a car from 1984, and it got me on track with these really special cars, including the picture I sent you, where I was racing against a, $4 to $5 million Porsche, 1950s Porsche 550 Spider. Um, so I think to wrap a bow on that part of the conversation, I think that's what I'd say. You can race cars are something that will always have a market because there's interest in them. People love to race. People love to see these things in action, and so that's always going to be a good part of the market. But of course, there is risk. When you buy a stock, sure, the stock could crash, but not the same way that a Porsche 550 could crash.
true. Very true.
Yeah.
Very true. So Jason, collectible car market is one of your interests. You like to
Hmm.
race,
Yep.
and you're an editor at large at Autoblog. So folks who
Yes.
want to hear more about these, let's just say, adventures and insights that you might have about the car market, Autoblog, that's the place to go.
Yep. Autoblog is the place to go, although I do write about it a lot I try to work a lot of automotive analogies, I think, into my writing, either on the Street Pro or certainly in Filthy Rich Animal, because I think it makes the content something that people can identify with. Um,
Wow.
Before we go, though, I do want to touch really quickly on Jaguar. Okay.
Okay.
Um, and so let's spend just a couple minutes talking about Jaguar, because again, as I mentioned, I was really lucky because the Jaguar team did bring me to Monterey, and there's been a lot of controversy around them because of what they've done to their brand recently. And Chris, before I get into it, I just want to ask a question: do you own a Jaguar?
No,
You don't.
no,
Okay. Do
most
you
certainly.
know?
So I have to come clean. We're
Yeah.
having this conversation, but I am the most non-car guy that you're going to find. Okay.
Okay.
So,
Okay.
so to give you an idea, I think that in one form or another, I have owned cars predominantly in the Honda family, whether it's Honda per se or Acura or some of these
Uh-huh.
others. So
So
not
you and
I
my
am
wife
not
could shop
I'm
for
not a
cars
gearhead,
together.
not a gearhead.
Well, let me ask you then another way. Do you know anyone who has bought a Jaguar in the last 10 years?
I mean, I might know maybe a handful of people, but that would
Really? Okay.
I would
Yeah.
say that I'm hedging because I'm not sure, but
Yeah.
certainly not more than a handful.
Well, I'm going to tell you, really, the answers to both these questions are for most people, nobody owns a Jaguar. Nobody knows anyone who's bought one in the last 10 years. Their sales had been falling through the floor. And Jaguar was basically a brand that was in distress. It was a brand that was failing. The other interesting thing about Jaguar, okay, is that it's not a standalone company. Right, it's a brand that has 90-year history. I could tell you all about the history, but I'm not going to bore our
Not today.
listeners.
Not today.
Not today. So what I want to talk about though is the Jaguar went and they decided that because they are a part of a portfolio of companies, so Jaguar is part of the Jaguar Land Rover group, which
Hmm.
is owned by Tata Motors, an Indian company, um, and so they're really the luxury part of Tata's portfolio. Now, there are some big things happening in the car market these days. Can you name what might be happening in the car market right now, Chris? Something going
Oh,
on.
are you talking about hydrogen cars?
I'm talking about your close electrification. And the
Oh,
other thing
right.
is
Yeah, yeah. I've
vehicles,
heard something about this.
yeah, and vehicles are also becoming more software defined. You might have heard the term autonomy thrown around,
Hmm. Hmm.
right? So in the Tata group, you have this brand, okay, that was basically failing. And Tata looked at what it had and it said, hey, we got to do something with Jaguar. We see a lot of potential for Jaguar, but we have no customers right now. Let's figure out what we can do. And so what they did is they said, all right, um, Range Rover is very successful. And they also said between Range Rover, Land Rover, and Jaguar, this part of the portfolio, we have $18 billion to spend over the next 5 years in R&D. Let's take a chunk of that, give that to Jaguar, and try to figure out what Jaguar should be in the future, right? What Jaguar is going to look like for a reboot of this brand. And this is not the first reboot that Jaguar has had, right? Jaguar, Sir William Lyons, who founded the company many years ago, maybe it wasn't, I think he was the founder. He said a Jaguar should be a copy of nothing. And there have been multiple times where Jaguar has reinvented itself. This is the latest in Jaguar's attempt to invent itself. I have no idea if it will be successful. What I do know is that Jaguar well, Tata sees this as a chance to go and invest heavily in electrification, which is the future of cars. As a gearhead, I'm here for it. I'm looking forward to it because I'll always have my gas cars and I'll race gas cars. But I'm excited for. I love what you get with an electric car. That instant power, that smoothness, but and then even autonomy. People that don't want to drive, Chris, they shouldn't have to drive, right? Get them off the road, so that people who do want to drive can drive and have fun.
So
Um,
Jason, let
yeah.
me just say this: the topic
Mhm.
of autonomous cars is a very big one,
Yep.
and I think that you and I should have a separate podcast conversation on this because a few
Hmm.
years ago I met with the folks at Audi, and they laid out the path to truly autonomous cars and what the
Yes.
implications were, not just on the car market, but how buildings are being constructed, how parking lots are
Yes.
being constructed, how home design and construction will change.
Hmm.
I would throw in how it's probably going to alter the business models of Hertz, right, and other car rental companies. So
Absolutely.
I think if you'll forgive me, let's put a pin in that and
Okay.
come back to it because I think it's a much larger conversation.
Yeah. So yeah, then I think we can kind of wrap it up. The things that I want to identify though is that people have been very critical of Jaguar's rebrand. And the thing that they don't understand is that this is a rebrand of one part of a portfolio. But what it really is the test bed. And I think it's really exciting to see what could be coming down the road for Land Rover as well. Jaguar is also moving into a different niche um, in their customer base. what they saw was that their customer base was getting older and narrower, right? And they decided that they needed to go after a younger customer base that was also a broader customer base.
Now, I know I'm on a gearhead. I'm going to ask you a
Uh-huh.
question about this, and because
Yeah.
I think I might be onto something.
Okay.
And then we're going to wrap it up. So my
Yes.
question is, is it me, or does this sound a lot like what Cadillac went through?
Absolutely. And Oldsmobile, remember, this is not your father's Oldsmobile. Um, and look where Oldsmobile is today, right? They're gone, but that was there was an issue at GM. Um,
Well, I
so
just say
yeah.
that because I think of the Cadillac that my dad had,
Hmm.
where it was a sedan and you could lay down in the back, like stretch totally out. You could
Yeah.
put, if you were, just because of my last name, I can say this, you could put some bodies in the back trunk, right?
Right.
And do what you were doing. But now during the US Open, you see a Cadillac commercial for a all electric, semi-autonomous SUV. Very different. So
Very
it sounds
different.
to me
Yep.
like this is what you're saying, that Jaguar is on the cusp of a potential transformation akin to what Cadillac did. Perhaps it's a reboot, but we need to
Hmm.
wait and see.
And you know who else did a similar thing is Rolls-Royce. We
Mm.
all think about Rolls-Royce as a stodgy brand, but the average age of a new Rolls-Royce now is something I believe it's in the mid to late 30s. Jaguar is looking to not be at the same level as Rolls-Royce, but their current portfolio of cars is for sale for in the $65,000 range. They're hoping to go more to $130,000, right? So slot in at a premium level, but not as high as a Rolls-Royce, probably competing more with a Cadillac and a BMW or even top level Teslas. And create cars that are more design forward and more interesting and could go after that younger audience that is looking to make a statement about what they drive.
Well, I'll say this, Jason. It sounds like something to watch, and I suspect that folks can follow you over on Autoblog and watch you kind of um, monitor the development and report back. And I look forward to talking more about this and autonomous driving
Yeah,
with you on a future podcast.
let's do it. I'm excited
All right.
for it.
All right.
Thanks,
Thanks,
Chris.
Jason. Thank you for being my mystery guest for this particular episode. And folks, thanks so much for tuning in. We'll be back with another Stocks and Markets podcast before you know it.